Greetings, fellow traders. Today we're venturing into uncharted territories to shed light on the enigmatic world of break and retest in forex trading. Throughout this video, we will discuss what break and retest is in forex trading, how to trade break and retest, how to incorporate break and retest in your trading strategy, and finally, how to create a whole trading strategy around break and retest only. But of course, before we can talk about break and retest, we need to understand what are market structures. Market structure is a collective term for support and resistance. These are zones or levels on the chart where that price would usually do a simple retracement or a complete reversal of a trend. Typically, the zones where price tends to reverse strongly and aggressively are called supply and demand zones, which are stronger versions of support and resistance. But that's not the topic for today. In fact, both these topics are already covered in depth within the 30 chapters free forex trading course that I will be dropping once I hit 10,000 subscribers. So if you're interested in such a course, then do yourself a favor and subscribe to the channel, like, and comment so the YouTube algorithm can promote this and other videos even more. Anyway, let's get back to it. As the market continues to move, the price will push past these barriers, aka market structures, which is where we get the term break. After the breaking of said structure, most times the price would then do a small reversal in direction, what we call a retracement or pullback, to the very zone that it just broke, which is what we call the retest of market structure. Keep in mind, this does not happen all the time, but rather most of the time to validate the break of the structure. As I mentioned earlier, I won't be going too far in depth with the explanation, however. A support is a zone that blocks the price from going further down, which could then cause a retracement. On the other hand, resistance is a zone that stops prices from going further up. Once the price breaks below support, that level now acts as a resistance. Likewise, once the price breaks above resistance, that zone now becomes a support. To put it short, once the structure is broken, the role of that structure is then reversed. It is to be duly noted that a support and resistance is not a single price, but a zone consisting of a range of prices. For example, as you see here, there is a higher price as well as there is a lower price that tells you the range of the zone. So every price within that range makes up the structure. Now then, let's get back to the main topic at hand. In forex trading, break and retest is a trading strategy based on price action analysis. It involves identifying key support or resistance levels on a price chart and waiting for the price to break through these levels before entering a trade. After the break, traders then look for a retest of the broken level, which serves as confirmation that the breakout is valid. To put it differently, this strategy revolves around the concept of price breaking through a significant level, then retracing back to retest that level before potentially continuing its movement in the direction of the breakout. Here's how the break and retest strategy typically works. Identify key levels. Traders first identify significant support or resistance levels on the price chart. These levels are often determined by previous swing highs or lows, trend lines, or other technical indicators. Wait for breakout. Once the key level is identified, traders wait for the price to break through that level. For example, if the price breaks above a resistance level, it suggests bullish momentum, while a break below a support level indicates bearish momentum. Confirmation retest. After the initial breakout, traders wait for a retest of the broken level. This means that the price returns to test the previous resistance, which should now act as support in the case of a breakout to the upside, or the previous support now acting as resistance in the case of a breakout to the downside. Entry and stop placement. Traders often enter the trade after the retest confirms the breakout. Entry can be placed either on the retest candlestick pattern or after the retest has shown signs of holding. Stop-loss orders are typically placed below the support level for long trades, or above the resistance level for short trades to limit potential losses if the breakout fails. Trade management. Once in the trade, traders may employ various techniques for managing their positions, such as trailing stops, scaling in or out of positions, or taking partial profits at predetermined levels. Risk management. As with any trading strategy, risk management is crucial. Traders should always consider the potential risk-to-reward ratio before entering a trade and should never risk more than they can afford to lose. Regardless of the type of strategy you use, break and retest could add more feasibility to it, especially if you are a price action pattern trader. Of course, trading any price action patterns involves utilizing the break and retest of market structure. head and shoulders, double top, triple top, or even a symmetrical triangle like what you see here in one of our previous videos. For your convenience, I'll make sure to add that video to the end screen so you can watch after this one. It's a perfect example of how to trade price action patterns, since the concept of trading all patterns is fundamentally the same. If you're a scalper, waiting for the break and retest of a structure to validate the direction of the market would then lower the risk of your trades. If the price breaks the support you see here and then retests, this increases the probability of the price continuing to go down. As such, you would then just sell as the price continues to go down, as you would want to trade in the direction of the market. Not only will this lower your risk of each trade, but also increase your win rate, causing you to make more money. The break and retest strategy aims to capitalize on the momentum generated by a breakout while seeking confirmation from a retest of the broken level. However, like any trading strategy, it's important to combine it with proper risk management and to consider other factors such as market conditions, trend analysis, and fundamental factors. Overall, break and retest trading is a versatile strategy that can be applied across different time frames and markets. By combining technical analysis with prudent risk management, traders aim to profit from the momentum generated by price breakouts while minimizing the risk of false signals. One of the best things about a break and retest trading strategy is that it forces you to trade in the direction of the trend. Your stop loss and take profit are predetermined. Lower risk of your trade losing. Give you confirmation on each trade. No indicator is required, so adding an indicator is just a bonus. These are just a few among many of the benefits of break and retest trading in forex. But for the video, we will leave it there. Now allow me to show you how to simply trade just by using a break and retest strategy. Going to show you two strategies, one involving the moving average and one without. But first, let's start with the strategy without the moving average. Use the rectangle drawing tool provided by TradingView or MetaTrader, preferably TradingView. Now draw the rectangle at the most recent structure created by price. Of course, if the price is below the most recent structure, the price is likely to be in a downtrend. If the price is above the most recent structure that was retested, that means the market is in an uptrend. But here's what most people don't understand. Your rectangle drawing tool must cover the length of the wicks within the zone. Wicks are the lines at the top or bottom of a candlestick. When utilizing this strategy in real time, what you are going to notice is that the price would just come at the lowest point of a wick, the highest, or sometimes in between, then continue in the respective trend, like what you see here. But how do you know when it's time to enter? That's simple. We simply wait for a confirmation candlestick. Candlestick patterns are a topic by itself, so we are not going to get into details with that. So in a nutshell, we just want to see a reversal candlestick pattern, which usually consists of our confirmation candle. A confirmation candle sometimes comes in the form of a large momentum candle in the direction of the trending. As you see here, the price broke the resistance and retested said structure, which started acting as a support. A couple of hours later, a confirmation candle was formed. Please note this confirmation candle is exceptionally large, and these are formed on rare occasions such as news. Here's a better example. The next thing to be noted is where you are going to put your stop loss. This is best placed under or above the previous swing high in a downtrend or the previous swing low in an uptrend. These are the highest points where the price retests at the structure and then reverses shortly after. This will make sure that your stop loss is not too small but also not too big. As regards your take profit, I highly recommend setting take profit 2 times the size of your stop loss. As such, for each trade, your risk-reward ratio is 1:2, meaning if you made 2 trades, 1 win and 1 loss, you would still be in profit because you would need to lose 2 times in a row to lose all the money you gained from the winning trade. As I mentioned, no indicator is required, but adding one would just add confluence to your trades. So I like to use the stochastic oscillator, which is great at helping to identify reversal points. The second strategy that I mentioned involves using the 150-period exponential moving averages. The moving average acts as a dynamic support and resistance while also telling you the direction of the market. If the 50 EMA is below the 100 EMA, that means the market is in a downtrend. Vice versa, if the 50 EMA is above the 100, that means that the market is in an uptrend, and you would only want to look for buys. Observe how the price reacts every time it approaches the indicator and wait for a candlestick reversal pattern. then your confirmation candlestick. I don't typically like this strategy, being that the stop loss is usually placed slightly above or below the 100 EMA, making it too small. But then again, no strategy guarantees a 100% win rate, so it boils down to what the trader is more comfortable with. If you found this video helpful and want to learn more about mastering the Forex market, be sure to hit that subscribe button to join our community of aspiring traders. We release lots of valuable content like this, so don't miss out on any of it. Thank you for watching.